A senior vice president of one of the largest oil companies in the world stood up at a Wall Street conference last Thursday and said something that should raise alarm bells everywhere. Global oil inventories are approaching, in his exact words, unheard of levels. Really low levels. And once they hit bottom, he warned, prices will shoot to $150 or even $160 a barrel. He said that could happen in just 2 to 3 weeks as we sit here in early June. This isn't a fringe prediction from an online commentator. Neil Chapman is ExxonMobil's senior vice president, one of the most senior oil executives on earth, speaking at the Bernstein Strategic Decisions Conference in New York. When someone at that level, with that kind of access to physical supply data, says prices will shoot up, it's definitely smart to pay attention. Before we continue, if this video was information, like and subscribe to our channel. It helps us out a lot. Here's what's actually happening beneath the surface of the oil market right now. Since the beginning of the war in Iran, the closure of the Strait of Hormuz has more or less trapped 1/5 of the world's oil supply in the Persian Gulf. The US Energy Information Administration assessed that Middle East producers shut in 10.5 million barrels per day of crude oil production in April alone. By the late part of May, global oil inventories are now falling by an average of 8.5 million barrels per day in the second quarter of 2026. To put that in plain terms, the world is burning through its emergency reserves at a rate that has no modern precedent. So, why haven't prices already exploded? Well, it's because the world has been quietly raiding its emergency buffers. Strategic petroleum reserves across Western nations have been released. Sanctioned crude from Iran, Venezuela and Russia, oil sitting unsold on tankers, got rushed to market to fill the gap. Saudi Arabia maxed out its overland pipeline to the Red Sea to route oil around the strait entirely. But now those temporary buffers are nearly gone. Chapman warned that once you hit those really low levels, the oil price will shoot up fast. Brookings institution analysts confirmed this. Once markets expect the temporary buffers to be exhausted, Brent crude could rise to nearly $150 per barrel, based on historical price models. Some analysts project prices could extend to $200 per barrel if demand destruction doesn't materialize fast enough. Chevron's CEO said something nearly identical at a separate conference. Physical shortages have already begun to appear in different parts of the world. The disruption, he said, could be as large in scale as the 1970s oil crisis in parts of the world. In America, this question is being asked, we produce more oil than anyone. Why can't we just drill our way out of this? Despite being a major oil producer, domestic production won't help curb rising prices at the pump anytime soon. Gas prices are currently hovering around multi-year highs going back to Russia's invasion of Ukraine. The EIA projects US crude production to average around 13.5 million barrels per day in 2026. Actually a slight decline from 2025. This marks the first contraction after 4 consecutive years of expansion. Also, shale companies have shifted their priorities. They are now focused on free cash flow and investor returns rather than aggressive production growth. Even if oil prices spike, producers are less likely to immediately ramp up drilling. And here's the part nobody mentions. The United States still imports roughly 6 million barrels of crude oil a day. Higher oil prices mean America earns more on what it exports but pays more on what it imports. The math doesn't help consumers at the pump. Drill baby drill is a political slogan in America. The physical reality of the oil market is considerably more complicated. If prices rise dramatically, here's what $150 to $200 oil looks like. The average American household spends between $2,000 and $3,000 per year on gasoline. At $150 oil, that number climbs toward $4,500 to $5,000 per year. But gasoline is only the most visible cost. Oil is embedded in everything. Higher oil prices directly translate to more expensive food, air travel, construction, and manufacturing costs across every industry. Every product that gets shipped, grown, built, or flown becomes more expensive when oil moves from $90 to $160. And one thing to watch is helium. The semiconductor industry, which powers the AI boom, accounts for 20 to 25% of annual helium consumption. Qatar produces 1/3 of the world's helium. and the only way to ship it is through the Strait of Hormuz. So, the inflation and possible economic implications are severe, while the United States and parts of the world will be resilient. Around the world is a darker story. Developing nations, the ones with no strategic reserves, no safety nets, and currencies already under pressure, absorb the full shock with nothing to cushion it. The World Bank describes it as hitting in waves. First energy prices, then food prices, then inflation that pushes up interest rates and makes debt more expensive. For billions of people, this isn't about a painful summer at the pump, it's about whether they can afford to eat. As we head into early summer, time seems to be running out. The Brookings institution is pointed on this. If the Strait of Hormuz does not meaningfully reopen by the end of June, the price trajectory becomes increasingly difficult to contain. Oil prices have stayed fairly subdued on hopes of a peace deal since April, but every previous deal signal over the past several weeks has faded. The physical inventory clock doesn't care about diplomatic optimism. Oil levels are depleting fast, and the people who trade it for a living are saying so out loud. Let's hope a deal can be reached. Thanks for watching. The sources for this video are linked below. Forbes, CNBC, the EIA's May Energy Outlook, Brookings Institution, and Scientific American. All worth reading. We find the journalism that matters and make it accessible. Thanks for watching, and don't forget to subscribe.